I'm from Hamzei Analytics. It's 6:05, March 9, 2011, Central Time. This evening we have Steve Ribble with us from shrinkmytaxes.com. Jeffrey Lynn of MarketHEIST, who has put this thing together, this event together. He'll be taking over here for me, and I think it should be a very interesting presentation. Without further ado, Jeffrey, it's all yours. Go ahead.
All right. Hey, good afternoon and good evening, everybody. Thanks for joining us. As Ferry was just mentioning, we're doing this more as a public service presentation. A lot of what we read on news and especially as active traders, a lot of the things we talk about is what's happening right now, not even 2 days from now. But trading, if you're doing it actively, it is more like a business, and there are other things you need to think about. One of the biggest things for business is taxes and how you incorporate and what advantages you can take from that, so that when you are trading, you can just focus on that and make that your primary focus. In December, we had another webinar with Steve the first time, and talking about trader taxation, electing that status to get you prepped for the end of 2010, and we got such a great response that we thought, hey, we bring Steve back and talk a little bit more about what kind of tax advantages and how exactly do you do that, including doing different kinds like LLC partnerships, and you at this point in the tax season, hopefully everybody's done. We can probably get a show of hands of how many of you actually have done it, but you got to do this early on in the year so that by the time year end comes, you actually get those advantages. So I'll leave that up to Steve. I just want to mention his website, shrinkmytaxes.com. A lot of great resources, just basics, even for right now, just general tax tips, financial guides. They'll even tell you how to live your life, how to get married. That's probably what I'm thinking about doing later. But for right now, you can follow Steve and get his information live. And he trades with us, so you can see his trading ideas and how he's doing on twitter.com/shrinkmytaxes. So I will hand this over to Steve, and I'm sure we'll all learn a lot just like last time, and either something you could ask Steve about, how to follow up, and you can contact him through Twitter, or we'll send out his email, and that is it. Look forward to a good presentation, Steve.
Thanks, Jeffrey. Appreciate the kind words. Hopefully everybody can hear me okay. I'm fighting a sinus infection. I was joking with Jeff earlier in the week that I felt like I had the Ebola virus, but I'm starting to see the light at the end of the tunnel and starting to feel a little bit better. But if you hear me breaking off into a coughing fit, just bear with me there as I get some water and try to get back at this.
Hey, Steve, you sound great. It is great radio voice.
Oh, thank you. Well, yeah, it is definitely tax time, and for those of you that have S-corps, I mean, your filing date's coming up relatively quickly. And this webinar this evening is really a follow-up to the webinar we did back in December, where I really spent most of the time talking about the taxation of the different security and future contracts, and we talked about qualifying for trader status and mark-to-market and stuff like that. I'm going to review a few things tonight, and I'll show you the agenda here in a second, but we're going to review a few of those things tonight, but we're going to spend most of the time talking about trader entities and really why you should incorporate your trading business if you haven't done so going forward. And we should have time for questions at the end as well. So if you've got questions, you guys can queue them up, and I'll get to them as I can. Just going to go through. There we go. All right, I thought I'd started out with a little bit of an accountant humor, and accountants really aren't known for our sense of humor, but I thought this was pretty funny, and if you've met some different accountants, you might think it's kind of appropriate as well. But what's the difference between an introverted accountant and an extroverted accountant? Well, the primary difference is an introverted accountant looks at his shoes when he's talking to you, and the extroverted accountant looks at your shoes when he's talking to you. So there we go. Disclaimer, this presentation is informational, educational only. It's not going to represent specific tax advice on the part of Shrink My Taxes. We recognize that everybody's got unique situations out there, and you should consult one-on-one with a qualified tax professional for your own situations. Also, just to say that Hamzei Analytics and MarketHEIST, Fari said it earlier, and Jeffrey kind of reiterated, this is a public service announcement. They are not in the business of giving tax advice, and so they make no representation that the material contained in this presentation is accurate and whatnot. So they're not the tax advisors. Shrink My Taxes, we are, and that's what we're here for. So Judge Learned Hand, I came across this quote, and I thought it really fits into taxation. A lot of times people, they go in to see their tax advisor, and it's April 15th, and they hand them a stack of receipts and try to pay the least amount of taxes possible. And as Jeffrey said, that's not the time to do it. You got to start thinking about these things and planning for these things. And I thought this quote was very appropriate. It says, "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for nobody owes any public duty to pay more than the law demands." And I think that is extremely true, and that's really the founding principles behind Shrink My Taxes, was to really help people proactively cut their tax bills. We all pay a lot of taxes, and some of us obviously pay more than others, but if you're proactive and take advantage of the tax laws that are on the books, there's definitely legal ways that you can slash your tax bills, and that's really what we're all about. So looking at tonight's agenda, I wanted to review qualifying for trader status. I still get a lot of questions on that, so we'll talk a little bit about that. And I also want to talk about mark-to-market accounting. I think that's one of the keys to the kingdom, if you will. If you're going to go out there and be in the business of trading, that you should look at electing mark-to-market accounting. It makes a lot of sense for a lot of people, but in some instances it doesn't make sense. So we'll talk about that. And then we're going to spend the rest of the time on trading entities. We'll talk about why form a trading entity. We'll talk about the different types of trading entities that you can do: sole proprietors, LLCs, S corps, partnerships, and C corps. And then we'll finish up with some entity cautions. Just some things that I see from an accounting standpoint that I want to make sure I caution people about when they set up their trading entities. So starting out, we'll look at trader or investor. Are you a trader? The IRS really offers no clear definition, and I believe in my heart of hearts that they try to be as vague as possible so that they have a lot of gray areas that they can go after people on. But it's trading is not defined in the Internal Revenue Code or in any tax regulations. Most of what we know about qualifying for trader status actually comes from court cases over the years. Moeller versus United States in '83, and the Paoli case, and the Mayer case, and the Steffler case, et cetera, et cetera. I've listed some, Jeff mentioned my website. I actually listed some of the most notable trader cases on my website, so I would definitely encourage you to go there, visit it, review some of those trader cases, and find out what people are doing where they've lost their trader status, and obviously make sure you're not doing those things. Definitely use that resource. But let's look at what the IRS actually says about qualifying for a trader status. And this comes from the IRS website. I've put the URL right there. You can go check it out. It's topic 429, Traders and Securities. So what the IRS actually says, to qualify for trader status, you must seek to profit from daily market movements in the prices of securities and not from dividends, interest, or capital appreciation. Your activity must be substantial, and you must carry on the activity with continuity and regularity. It's very specific, right, people? Again, it's very ambiguous, and you really can't tell any specifics about what they're looking for. But you can kind of narrow it down. And what they're looking for, in essence, is the holding periods for securities bought and sold, the frequency and the dollar amount of your trades during the year, the extent at which you pursue this activity to produce income for a livelihood, and that's going to be important for people who are looking at trading entities, and the amount of time you devote to that activity. So those are predominantly the four things the IRS looks at when they review trader cases. You miss one of those four, and the IRS catches it, then what will happen is you will lose trader status, and that means that you're going to be taxed as an investor. You'll lose a home office deduction because investors cannot take home office deductions. You'll lose investment seminar and educational seminar deductions, margin interest, which cannot exceed investment income for investors, and you'll also have to place that on your Schedule A, which will be subject to a 2% of your HEI. You'll be subject to wash sale rules, and you cannot use mark-to-market Section 475 accounting, which is a key. So if you qualify for trader status and you've elected mark-to-market accounting and you're not trading frequently enough, or you're not trading with the volume enough to continue to qualify for trader status, and the IRS catches you, you can lose that mark-to-market accounting, and all of your ordinary losses that you may have accumulated are now going to get flipped over to capital losses, and the restrictions there are $3,000 on your taxes. So I mean, that's a big deal. So you want to make sure you're aware of trader tax laws and what the IRS looks for, and make sure that you're hitting those things consistently. So some general guidelines for your own trading businesses. You should have a substantial portion of your liquid net worth trading the market. If you've got $1 million portfolio and you've got 25 grand in your trading account, that's not a substantial portion of your liquid net worth, and you're not going to meet that requirement. So be aware of that. You should have weekly buys and sells. Daily obviously is going to be the best, but you should be trading at least on a weekly basis. Substantial number of your buy and sell spread throughout the year. North of 500 trades for the year, you're generally safe. If you're trading in the 100 to 200 range, it's going to be tough to uphold trader status. I do know of a trader case. Excuse me one second. I do know of a trader case where the gentleman did about 95% of his trades in the first 4 months of the year and traded very little for the remainder of the year. IRS actually caught it, and he lost his trader status and had a huge tax mess as a result of this. So you got to make sure that you're being consistent in your trading throughout the year. You can't take any lags there in your trading activity. Typical holding periods under a month. Obviously, weekly or daily is even better. You should spend a substantial time watching and trading the markets, looking for three hours a day minimum that you're active in the markets. I would always suggest keep a time log, because we know as traders there's going to be situations where you do not trade, whether the market's not reacting right, or you're just not feeling it that day, for whatever the reason. But you do want to document that you're there reviewing the markets, or you're there watching webinars, or whatever the case may be. But keep a time log so that if the IRS ever comes calling, you've got documentation, you've got records that you're actually running it as a business. And finally, maintain a business-like operation. You've got to take this serious as a business. That means keep good books and records, whether you're keeping QuickBooks or other records of your operations, and keep that trading journal. Again, the more documentations, the better your paper trail, the better your case you can make it if you ever get audited by the IRS. So how do you elect trader status? Well, if you have not elected trader status and it's something that you're thinking of, the good news is there's actually no formal election. There's not really anything you need to do. You can claim, if you haven't filed your taxes for last year yet, you can actually claim trader status. You can go back and claim trader status for 07 through 09 if you didn't claim it for those years by filing amended returns. And we would include your expenses on your Schedule C, which is a profit and loss from a business. That would be the big difference, is that we actually attach a Schedule C to your tax form as you file the amendments. So it's not really a formal election. There's not a formal process in order to claim trader status. You just, if you meet the qualifications, you can file that Schedule C with your personal return and take your expenses that way. If you're not sure you qualify, plugging the website, once again, you always got to plug your website. I've actually put up on my website the trader tax questionnaire. At the top, you'll see a tab for trader taxation, and if you click on that, you'll see a link to the trader tax questionnaire analysis. You can download that, fill it out, fax it in, or scan and email it back to me, and I'll review your situation and get back with you with my thoughts on that and how you would qualify for trader taxation or trader status. So that's definitely there. Pull that up. Feel free to send that in to me, and there's no cost to do it. I'll do that for free. So let's look at mark-to-market accounting, and this is, I kind of joked before, but this is the keys to the kingdom, if you will, and this really is where you can generate significant tax savings if you're a trader who's not yet profitable. So let's look a little bit about mark-to-market accounting. This falls under in the Internal Revenue Code Section 475, and in essence, what mark-to-market accounting is, and it's a change of accounting in how you account your trades, and it's going to convert your capital gains and losses into ordinary gains and losses. It's done at the end of the year. At the end of the year, all open positions are priced as if they are sold on the last day, trading day in December. So if you carried any positions over from, let's say, December 31st, if that was a trading day, you would price it as if it was sold on the 31st and bought back on the 1st trading day. So you got to take any inherent gains or losses on that position. You got to take it for the accounting methods. It's reported on Form 4797, which is sale of business asset or business property. And here's the key. Ordinary losses can deduct or may be deducted in full against any type of tax return income. So if you have a spouse or that works and has a W-2 job, or if you have a part-time job or full-time job somewhere else, or another business, if you rack up trading losses and you've got mark-to-market accounting, you can actually take all of those losses against the other income that you've got on your tax forms. If you don't have income, or if it exceeds that income, you can actually go back up to 2 years for immediate tax refunds by filing amended returns. They're 1040Xs. Or you carry forward up to 20 years, and it counts towards future income. So, I mean, that's a huge benefit there. If you look at it side by side, we've got a trader that is under the cash method or the regular method, and then you've got a trader electing mark-to-market. You'll notice that gains are taxed as ordinary income, and what I'm referring to under the trader is if he's trading, it's mostly short-term, so all of those are going to get taxed at ordinary income levels, and that's the exact same way that it happens under mark-to-market. So there is no difference there. The only difference is long-term positions obviously would be more beneficial under the cash method. Losses, this is where you can see the huge difference. Losses under the cash method are limited to wiping out the capital gains, plus being able to take up to $3,000 capital loss off your taxes. Losses on mark-to-market are taken in full. It's an ordinary loss, so it's actually taken in full. The cash method, you cannot carry back losses. With mark-to-market, you can carry losses back up to 2 years, and you can carry forward losses until used up under the cash method, and mark-to-market, you can carry losses forward up to 20 years to wipe out future income. So you can see that there's not really that much difference except for the way that the losses are treated, and that's a huge deal if you're a trader that is not quite profitable. Electing mark-to-market, how do you do this? There's a few things that you got to go through. Unlike trader status, where there's not really a formal election to make, when you do elect mark-to-market, there actually is some formal elections that you have to undertake. If you make a mistake or you file late or miss any of the deadlines that we'll talk about here in a second, you can lose out on the benefits, and you're going to have to wait another 12 months in order to try again. So there's 3 important steps, and excuse me, it's 3 important steps that you have to undertake. It's you first have to attach an election to a prior year tax return or the extension. You've got to file Form 3115, which is change of accounting method, while filing your current year's tax return. And then you've got to take a Section 481 adjustment on Form 3115 and on the tax return Form 4797. And I'll talk about that here in a second. Attach the election statement to the prior year tax return. So to elect mark-to-market for 2011, you would attach and send in with your 2010 tax return by the due date of 4/15 of this year. And an example of a statement would be, I hereby elect to use the mark-to-market method of accounting under Section 475F of the Internal Revenue Code for my trade or business of trading securities. The first year for which the election is effective is the taxable year beginning January 1st, 2011. And that's pretty much it. You have to attach that statement and send that in with your 1040. Next thing you need to do, which actually is not due until next year when you filed your 2011 tax return, is you have to also fill out Form 3115, change of accounting method, and but again, that's not due until you file 2011 taxes, which would be in 2012. If you have any open positions when you make the election, you have to calculate and report a Section 481 adjustment on Form 3115 and tax return Form 4797. So if you have open positions and you have unrealized gains on those positions, you can actually prorate the gain over the next 4 years, so take 25% every year over the next 4 years. But if you do have losses, unrealized losses on those open positions, those are 100% deductible. So just some hoops that you have to jump through there. I will say most of the time, if you are a securities trader, if you trade stocks or options, taking the mark-to-market election makes the most sense. If you are a futures trader and you are profitable, I would tell you not to take the election on your futures business, because futures are taxed 60/40, and you're going to give up some taxation benefits because of that. So it really depends on your particular business and where you are in your trading careers and profitability-wise, if it makes sense to take mark-to-market or not. You can take it on securities and not take it on futures. If you trade both, you can do that. So there's not a problem if you're trading different instruments out there. Okay, so let's jump into trading entities. And we'll start out by looking at why should you form a trading entity.